Hello and welcome to Portfolio Matters. And it's been another eventful week in the markets. But before we get into it, Richard will read the disclaimer.
Thank you very much, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what do we have this week?
So, well, first of all, I'm sorry about the late notice. We have Portfolio Matters pub night on next Wednesday, actually, at the King's Arms near Waterloo. I hope a few of you will be able to join us. Matthias will be coming over from Germany to talk about Harbour Energy. So I hope to see a few of you there. Okay, news this week. Well, it was a very eventful week in the market. So first of all, the Fed met and raised interest rates by 25 basis points as expected to a new range of 5 to 5.25%. And it changed its language, omitting the phrase, some additional policy firming may be warranted. So is that the peak in interest rates? Now, it also described conditions in the banking system as having improved since March, which was quite an odd thing to say in a week in which we've seen First Republic Bank essentially go bust and be taken over by JP Morgan, and in which we have seen further contagion into the whole of the US small banking sector, and we will go through that. And US rates are now above core sticky inflation, which is at 4.7%. So the Fed has managed to create positive real interest rates, and that is likely to get even greater in the coming months as inflation hopefully slows. Yesterday, after the FOMC met on Wednesday, there was a further sell-off in the shares of US regional banks, and PacWest shares fell 50% as it explores a potential sale. We talked previously, after the failure of Silicon Valley Bank, about how underlying conditions in the US banking system would continue to deteriorate over, we said then, the next 6 months. Well, it's been 6 weeks, and those underlying conditions have now worsened to the extent we seem to have a general crisis. The ECB also met this week, raising interest rates by 0.25% to 3.75%. The Bank of England's MPC meets next week. Elsewhere, the Bank of Japan met and kept rates and yield curve control unchanged, which was unexpected, and the yen fell. First Republic Bank was closed down by the California regulator last weekend and its assets sold to JP Morgan. The Federal Deposit Insurance Fund is expected to lose about $13 billion on the deal, and it has been talking about raising levies on larger US banks to enlarge its deposit fund, its deposit insurance fund. It becomes the second largest bank failure in US history after Washington Mutual, which failed during the GFC. Depositors were protected, shareholders were wiped out, bondholders took an enormous hit. We will talk about this in a minute. Elsewhere, Janet Yellen warned that the US Treasury may be unable to meet all its obligations as early as mid-June and possibly even the 1st of June. There is a call between Biden and Republican House Speaker Kevin McCarthy on the 9th of May to discuss this. In advance of that, the Democrats are warning that Republican proposals to cut the budget would cost up to 790,000 jobs. Well, the US fiscal budget is completely out of control, and it needs to be cut at some stage. And when it's cut, there will be consequences. Elsewhere, shares in online education company Chegg fell 50% after it warned of the effects of competition from AI. And is that a harbinger of the impact of AI on technology companies in particular? Okay, so some charts relating to the news. Well, this is the path of both US and European interest rates, and they have risen very quickly, and we've been warning for a long time how sharp rises in interest rates cause difficulties. They cause stress in the financial system, and the economies of the developed world are highly indebted and financialized, and you know that somewhere those very rapidly rising interest rates will cause stress, and we're seeing that now in the US regional banks. And this is a list of the largest US bank failures of all time, and we have had 3 of the top 4 this year.
And very much bigger, 10 times the size of some of the other ones.
No, that's right. And of course, this is in nominal terms. So, in real terms, you've probably deflated a bit, but still, this is a big crisis.
Yeah.
And this is share price of First Republic Bank. You see, shareholders got out, but bondholders also got not very much. And we think about the funding of US regional banks, this is going to have a real effect on their cost of funding. And I think it's absolutely inevitable we now get a credit crunch in the US as the cost of funding for US regional banks skyrockets, and therefore they need to be much more conservative and try and strengthen their balance sheets. And this is the ETF of US regional banks still falling.
I read, not terribly long ago, I read a recommendation to buy US regional banks ETF, maybe just before Silicon Valley went bust.
Well, on this podcast, Richard, we have been very clear that bottom fishing in bank stocks is a very, very dangerous game. Absolutely. And we have been dead right.
Yes.
Got a lot wrong recently, me personally, but in that case, absolutely right. Now, there is a difference, though, between the large US banks, which are heavily regulated and are doing just fine, thank you very much, and the small banks, which are not. And you see that confidence in the regional banking system is just evaporating. Now, JP Morgan, on the other hand, which bought the assets of First Republic, is dominating the banking system in the US, and it had to get a waiver, a competition waiver, in order to acquire First Republic. So, there are very positive returns to scale for JP Morgan, which is doing just fine. And a graphic illustrating the fact that we are having a record year of bank failures. So this is potentially the next domino to fall, and there are a few of them, honestly, but PacWest share price has fallen very rapidly following the failure of First Republic. And in the banking system, confidence is everything. So it's going to find it difficult to get loans, funding, etc. Now, good news is the European banking system has been performing much better. And so this is the relative performance of European banks versus US banks. And you see this year, they're massively outperformed. Turning to monetary policy, the blue line shows the expected path of US interest rates after the FOMC. And you see that that path has come down a lot since March. The market is increasingly concerned about the US economy, and it's assuming that the Fed will start cutting rates really quickly, actually, in August, and that the Fed has basically stopped raising from now. The next move by the Fed will be a cut, and in 3 months' time. Elsewhere, there are very funny things happening in the oil market. It's extraordinarily volatile. So it fell 5% on both Wednesday and Thursday, and then very odd, just big gaps down and then recovery. If anyone knows what's going on, please get in touch. Okay, and on to this week's economic data. So in the UK, we had mortgage approvals for March, which were very odd in that they showed a big bounce. Given that house prices have not fallen that much and that mortgage rates have risen a great deal, so housing affordability is very poor, it's very surprising that we've had basically almost a 25% increase in mortgage applications in March. It shows that UK house buyers are resilient and confident in both their future prospects and the housing market. Meanwhile, actual mortgage lending in March fell to essentially zero. So the mortgage approvals implies the recovery in mortgage lending in the coming months. Lending to individuals, on the other hand, fell and missed expectations, although that is still a decent number. Now, in the EU, we had flash inflation numbers for April, and they were not good. So they met expectations, but actually CPI rose from March to April, which is not good. And month on month, it was much worse than expectations, although down on March. Core CPI fell slightly, so that's reassuring. The unemployment rate, though, ticked down to 6.5%. So the labour market is still very tight, which implies inflationary pressures will also be persistent. Now,
sorry, I just think on the inflation numbers. Do you remember we showed that data from that paper from Research Associates, Rob Arnott's firm, a few months ago about historically how long it's taken for inflation to fall. And historically, when inflation gets up to the levels it has got up to, I can't remember the exact number, but it takes a significant number of months to fall. And all of the economic forecasts suggest that it's just going to disappear over the course of the next few months. So historically, that isn't what has been the case. And secondly, I think I mentioned last week, a lot of the, in the UK, a lot of food prices are going up because long-term contracts, which fix the prices, have come to an end, and the food producers are upping their prices very significantly in order to recoup the losses they made on the long-term contracts and make the current long-term contracts profitable. So I suspect that inflation is going to be hard to get down, and it's not going to come down in anything like the charts that we see from all of the economists.
Well, I very much hope you're wrong, Richard.
I do too, Keith, because I don't like it's very unpleasant.
Yeah, absolutely.
I think the problem then, of course, becomes what on earth do central banks do? You can't raise rates more to control it without crucifying the banking system. P.S. I don't think the European banking system is healthy. I think it just hasn't got hit yet for whatever reason.
Well, we know there are a lot of losses to be taken on commercial real estate, and that hasn't really started yet.
Yeah.
Well, moving on to China, we had two sets of PMIs, and I'm just going to talk about the NBS ones because they both showed the same picture. And that was unexpected weakness in the manufacturing sector. So in April, manufacturing was expected to weaken slightly from 51.9 to 51.4. In fact, it fell sharply to 49.2, so into contraction territory. And we've talked in previous weeks about how iron ore has been falling, and lots of the industrial commodities have been falling. And so this is not actually unexpected. The commodity markets have been saying that China's weak, and that is the first confirmation we've got from the PMIs. Non-manufacturing sector also weakened, but remained strongly positive. So overall, the Chinese economy is doing just fine, but it's weakening, not strengthening. Okay, moving on to the US. So we've had a whole dump of data. We had PCE inflation, which is the Fed's preferred measure of inflation, and that came down nicely. It fell to 4.2% in March from 5.1% in February, and month on month, that was a good number. Core PCE, not so good. It fell to 4.6% in March, only slightly down on February, and worse than expectations. Month on month, it remained at 0.3%, not great. Personal income beat expectation month on month. Wage growth continues to be quite strong. Personal spending, however, fell to essentially zero month on month. So consumers are saving, not spending. Moving on to the ISM manufacturing survey, that bounced a bit but remained in contraction territory. What was concerning was the prices paid ticked up. Prices are rising again. Not good news for the Fed. Now, we had the JOLTS job opening numbers, and they showed a sharp drop in job openings, but that's still a big number. We'll show you the chart in a bit. The quit rate also fell. So the US jobs market is weakening, but it's still very tight. Factory orders bounced back, and we had the ADP employment change numbers for April. Reminder, we've got the jobs report later this afternoon. And against all expectations, that strengthened strongly, showing strong job creation in April. And the Challenger job cuts showed a drop in job cuts. So the US economy doesn't appear to be actually weakening. In April, job creation was quite strong. And finally, we have the ISM services PMI, and that again strengthened in April above expectations. And what's really worrying is that prices paid again rose. So inflationary pressures in the service sector are not abating. New orders were strong. Now, in quarterly data, we had Eurozone GDP, and that was pretty weak, frankly. US labor costs in Q1 were worrying. So 6.3% annualized, massively up on Q4 2022 and beating expectations. Some charts, Richard.
Charts. So the economic update charts, UK mortgage approvals moving up from quite a low level.
Yeah, astonishing. Just mystifying to me.
Yeah, it is. I mean, you have to look at these things over the longer period as well, don't you? Of course, UK mortgage lending is effectively, there is no new mortgage lending. New loans are equaling capital repayments on existing. There we have UK consumer credit, which is pretty stable at around the 2 billion mark.
And actually a decent number. So
there's the EU CPI year on year, which is falling quite sharply from where it was a few months ago, and that falling trend has yet to be broken.
Well, it did tick up.
Yeah, but it's a tiny tick in comparison to the size of the fall. Yeah. I would say I think you need to reserve your position until we see that next month's data. And there we have the EU CPI month on month.
Yeah, that's not a reassuring number.
No, it's we shall have to see. EU core CPI, that's the one that looks like, have we got this licked? There's certainly no evidence that it is solved at all. The evidence actually from the chart is that it's not solved.
I agree.
And EU GDP year-on-year quarterly data, which shows that the rate of growth in the EU is very slow. And quarter-on-quarter, it's extremely slow. It's sort of more or less stagnant now in the current year. The Eurozone unemployment rates are still trending down, although at a slower rate than it was in the mid-2010s.
Yeah, The labour market in the EU is tight.
Yeah. There's the US PCE inflation year on year, which is falling and continuing to fall and showing a falling trend. The US PCE inflation month on month likewise looks much more healthy than in Europe. And the US core PCE inflation year on year starting to put in what could be the beginnings of a downtrend.
We hope.
Yeah. And there we have it month on month. US personal spending month on month basically didn't grow last month or the month before.
Mm.
And the US Chicago Business Barometer, it's a very noisy chart, this, isn't it, over the years. And it's moving up from a pretty low read a couple of months ago.
Well, the thing is, Richard, it is noisy, but I think it definitely reflects business conditions. Recession, early 2000s, GFC, 2020, and it's bounced back surprisingly strongly.
It has, yeah. The US ISM manufacturing PMIs, which are, I would say, haven't actually reversed their downtrend.
Yeah.
And the US ISM manufacturing employment, which is hovering around about 50.
Yeah, now this is an interesting puzzle, because normally when the PMI, manufacturing PMI, drops substantially below 50, as it has done, you get a big drop in employment. You can see that in 2020. This time, no change. So, one of the reasons the jobs market in the US is so tight is that companies are hoarding labor.
US ISM manufacturing new orders. Again, the downtrend may have reversed, but it's not clear as it has as yet. And with the increase in interest rates, you would expect that to have an impact on economic activity. The JOLTS job openings is falling,
but still amazingly strong.
Yeah.
Now, I had a conversation with a US fund manager yesterday who was saying that part of the explanation for the very strong JOLTS job opening numbers is that a lot of online job adverts, essentially, there's no cost to keeping them up there.
So a poor measure of the actual job openings.
Yeah, but at the same time, we know that jobs growth continues to surprise the upside. So it does seem that the labor market in the US remains very tight.
And the quits rate, the JOLTS job quits is falling, which means people are hanging on to their jobs a little bit tighter, but it's still pretty high. US ADP employment change is showing some strength. Yeah,
I mean, this is amazing. Absolutely, really, really surprising.
Yeah, and the challenge of job cuts, which if people remember, is if a US company which seeks to make unemployed above a certain number of individuals, they have to report it through this challenge process. So it is an advanced look at what job losses are going to be like in 1 or 2 months' time, and that's just dropping back down at the moment.
Yeah.
Red book retail sales continuing to fall steadily and quite quickly. US MBA 30-year mortgage rate steady at around 6.5%. US initial jobless claims has stabilized in the last 6 to 8 weeks. US continuing jobless claims has stabilized, really been stable for about the the same period of time, 6 to 8 weeks. And then we have the China manufacturing PMI, which is just around about 50.
Sharp drop.
Yep. And the non-manufacturing PMI, which is sustaining the gain that it's had over the last couple of months since reopening. And the general PMI, well into positive territory.
Yeah, that's still a good number, bit of a drop.
So we can't understand the bounce in UK mortgage approvals. Something weird going on there. But net mortgage lending in the month essentially zero, but you would expect net mortgage lending in the next few months to increase with the bounce in approvals. US PCE inflation is showing that inflation is continuing to gradually subside, but the core PCE inflation is being a bit more stubborn. ISM survey showed strength in economic activity in April, which is what the Fed doesn't want to see. And the manufacturing service sector is reporting rising prices paid, which the Fed doesn't want to see. And that may have been a function of rising oil prices. And then we've got ADP employment report is showing strong data, which the Fed doesn't want to see, which explains why they raised interest rates.
Yeah. Now, the Bank of Australia actually paused and then after a couple of months raised rates again. So, the market is assuming that the Fed will start cutting rates in August. Now, I just don't see how that is compatible with the data we are seeing now.
Yeah.
In order for that to be the case, you need to see a rapidly weakening US economy. Yeah. And so far, and we've been reporting this endlessly over the last few weeks and months, the leading indicators continue to deteriorate, but the actual economic data, hard data, is not deteriorating. So the market seems overconfident that there's going to be weakening US economy in the next few months. Now, the other thing I'd say about the UK housing market is that we had this strong bounce in mortgage approvals in March, but you'll notice that in February, there was still something like 40-odd thousand mortgage approvals, but net lending was zero. So what appears to be happening is that high mortgage rates are forcing a lot of people to try and repay their mortgages. And so I suspect the savings rate has gone up in the UK. Mm. And that should have negative implications for consumer spending.
The bottom line of all of this is we seem to have got resilience in the economies. They're not rolling over with the increase in interest rates. And we have persistent inflation. And that's not rolling over either. So the central banks are still on the horns of the dilemma. And we have discussed before the impact of fixed rates and what happens as fixed rates roll off. And I suspect we're still waiting to see that in the UK.
Yeah.
But some of this data is proving the economies are actually pretty resistant to increasing interest rates so far.
Yeah, it's been surprising. Okay, on to one chart. Okay, now we've talked about the resilience of the economy and the resilience, frankly, of stock markets, which have been rising over the last few weeks. And what is different this time is that previously, economic weakness in the US has been met by the Fed cutting interest rates. So the green line is ISM manufacturing PMI, and the yellow line is the Fed funds rate, interest rate. And you'll see going through the recessions, 1990, drop in the ISM manufacturing, Fed's cutting rate. 2000, manufacturing contracting, Fed starts cutting rates hard. GFC, the same. The same in the pandemic. Now we have ISM weak, but the Fed is continuing to raise rates and has stated that it will keep them there. Reminder, the Fed itself has been saying that it will now keep rates higher for longer. It is the bond market that is expecting them to cut. So this implies that monetary policy is out of sync with the economy because it needs to get inflation down. And it implies the Fed will be forcing further weakness in the manufacturing sector and the service sector in order to get inflation under control, and that is not good for risk assets. And on to Financial Crisis Watch. Okay, now, so last week we had data for the week ending the 19th of April. Reminder, tax revenues became payable on the 15th. So we've had that week contains some data for what we expect to be outflows from the banking system into the TGA account. Now, actually, what it shows is bank deposits didn't fall that much. This is small banks, flat, large banks. Is that a small net rise? So there is not much evidence so far of further declines in US bank deposits. However, survey data is showing that 48% of Americans are worried about their bank deposits, and they can fix that problem by moving their money out of their deposit account, earning 0.5%, and putting in a money market fund where they'll get 5%. So we expect deposits keep on falling. Now we have, this is loans and leases, and loan growth seems to be continuing. Now we had the TGA account, data the 26th of April, and you see there is a rise, a substantial rise last week. So when we get the data for bank deposits, you'd expect to see it dropping. This commercial real estate loans, that's pretty flat. All real estate loans, actually, that looks like a decent number.
They're all sort of curve flattening off, aren't they, Keith? Even the previous one, it's the rate of increase is tapering off quite quickly for all of them.
Yeah, well, we need to see what data's like for April when it comes.
Yeah.
Residential real estate loans actually were rising in March. Commercial and industrial loans were falling, though.
Yeah.
Now, Robin Brooks of the Institute of International Finance has these charts, which actually seem to contradict the data from the St. Louis Fed, and they are showing deposit growth falling in the big banks and loan growth from the small banks very disappointing, from the large banks actually better than medium, but well down on last year. Now, reminder, having done a couple of weeks in which we've talked about the credit impulse, both these bottom charts imply a strongly negative credit impulse, and that has to be bad for the economy going forward. And banks are piling up their bad loan provisions, although nowhere near to the extent of during the pandemic. And everywhere we are seeing tightening financial conditions, and financial conditions are a good predictor of the economic conditions and GDP, as we discussed from the credit impulse. And if you look at surveys of credit managers, well, they're saying they're rejecting applications. And on their earnings calls, more CEOs are talking about credit tightening than during the financial crisis, the GFC. Capital markets are essentially closed. There haven't been any IPOs. And last quarter, the S&P was downgrading lots of companies. That's the dark blue lines. Tightening credit conditions are causing small US businesses to shelve their expansion plans. And in the EU, banks are tightening lending standards. And this is the GavCal Economics True Financial Conditions Index. Reminder, most financial conditions indices use markets data, and what really matters is whether credit's flowing through the economy, and this attempts to measure that. And it's saying financial conditions are very tight. What this chart shows is the long-term trends in the Fed funds rate. And it draws this band between the maxima and minima. And you'll see that US interest rates are very tight by historic standards. So you would expect that to be having some effect on the economy. And we know that money supply is shrinking, and that happens very rarely. And money supply is falling at a rate we haven't seen since the Great Depression. In summary, we know that credit conditions are tight and tightening. The recent failure of First Republic and the wiping out of both shareholders and bondholders is going to increase the funding costs for small US banks. In fact, US banks in general, which will make them more conservative, make them attempt to strengthen their balance sheets by cutting loans, and that has to result in a credit crunch. And also, based on the share price of PacWest and other regional banks, we're expecting further bank failures in the coming weeks. So, watch this space. But as we've seen from the economic data is currently resilient. And despite all the leading indicators and the financial conditions indices implying a weakening economy, we are not seeing it. Inflation watch, Richard.
Thank you, Keith. So the new data that we've had this time around is we have the EU CPI, which is 7% for April, and the core, which is up, and core CPI 5.6% for April, which is down. The EU central bank interest rate is now 3.75%. So CPI is not behaving as the central bank and Christine Lagarde would like it to in Europe. So food inflation, Financial Times, and food inflation was 20% in annualized rate in March, which is German food price inflation fell 17.2% in April, down 5% from March. And if that follows through in the UK, we should see a chunky drop in UK food inflation over the course of the next few weeks. I hope so. And this is a breakdown of the seasonally adjusted core inflation between goods and services. And you can see that goods inflation in the EU is really quite low now, but services inflation is zooming away, out of control even.
Yeah, is strengthening, actually. Not good at all.
So month on month change in the national rent index in the US. It doesn't appear to be flying high, does it? It looks like it may be settling down at about 0.3%.
Yeah, but again, strengthening. I mean, you would hope that it's been falling. It would be falling.
Yeah. US rents falling year on year. This is the rate of increase of US rents year on year is falling and now down to about 2% in the US. And the apartment vacancy index showing a rising vacancy rate, which would coincide with falling rental.
Rates. So why are rents rising when vacancy rates are rising? Doesn't make sense.
Yeah. Also, I mean, this is probably national, and I suspect there are pockets. It's a very partial market, isn't it? And so it's hard to know whether you've got particular areas skewing the data. So US trueflation, which is a different measure of inflation, has dropped to 3.9%, and the UK trueflation is now 15.8%.
Yeah, actually, I looked at this midweek and it was 15.6. So it's actually risen by the last couple of days. Not good.
I mean, the US may have its interest rates at about the right level. The EU and the UK haven't. Well,
the thing is, Richard, it also remains the case that the transmission mechanism in the EU and the UK should be much faster, because in the US, all the homeowners have locked in 30-year rates at, bugger all.
Yeah.
Whereas
it seems to be the wrong way around, doesn't it, Keith?
Yeah.
So shipping rates have reverted to normal after pre-COVID normality. And clearly the drop in shipping rates should filter through to a reduction in prices of goods, the retail prices of goods. And the continuing drop in global container volumes suggests a slowdown of the global economy. So we have some good news and some bad news. So goods inflation is declining. Service inflation everywhere is persistent and rising, and the inflation problem in the US is much less severe than it is in the UK.
Yeah, but I agree. But I think a lot of the inflation problem in Europe was caused by energy prices. And when we get onto the energy sector, you'll see that energy prices really are collapsing. So you would hope with a lag that inflation does come under control.
Yes, completely, Keith. And I hope you're right. And of course, if we move into a recession, we would expect to see inflation fall substantially as goods demand drops and pricing pressure comes to the fore.
Let's hope so, because that is the big assumption, that the central banks raise interest rates, slow the economy, and that brings inflation down. Well, so far, it ain't working very well.
So I'm afraid that at this point, I'm going to bow out of the podcast because there's a little bit of a family problem that I need to address. And I'm going to leave the rest of it in Keith's capable hands, and we should be back properly next week.
Okay, thank you, Richard, and good luck.
Thank you, Keith.
And on to Recession Watch. This is the Eurozone, and you'll see that Greece and Portugal are doing much better than Germany. And I wonder whether that's because we know consumers, having been locked down in the pandemic, are very keen to travel. So the tourism countries are doing better than the industrial companies, where we know industrial goods demand is falling. Talking further about financial conditions, we know loan demand in the EU is dropping sharply. One of the puzzles we've seen around the world is that we've had weak manufacturing PMIs, but employment in the manufacturing sector has remained strong. Now, this is from Germany, and what it shows is there remains a strong order backlog. So although current conditions and orders are weak, manufacturers can keep themselves going on the backlog. And if that is true elsewhere in the world, it will explain why manufacturing employment remains strong and actually is unlikely to drop anytime soon. In the US, lumber futures have fallen right back to their lows pre-pandemic, and you would think that implies weak construction demand. And layoffs are rising. Data as of March. US companies are increasingly talking about weak demand on their earnings calls. The Duncan leading indicator, which we haven't covered before, is also implying weakening economic growth in the future. And the Duncan leading indicator is the ratio of consumer durable goods spending plus residential fixed investment to final sales. And if we look at the aggregate of the Fed's surveys of how the economy is doing within their region, you'll see that that is rapidly declining and implies recession. And the composite leading indicator is below 100 and falling and approaching recession territory. Real estate prices in the US have fallen sharply, particularly for commercial real estate, and that will have very negative implications for banks and whoever has loaned the money to make those real estate developments. And we're expecting big losses as the year develops. And this is a breakdown of commercial real estate prices, and you'll see office prices are down 25% from their peak Apartment prices, not much better. And Ray Dalio thinks that we are on the brink of a period of great disorder, and his mental model is here, and he thinks we are at the brink of a precipice. Well, so far, there is no data to support that, although all the leading indicators support that judgment. According to Bloomberg, the countries with the highest risk of recession this year are the UK, number one, with 75%, New Zealand, then the US at 65%. Germany, Italy, Canada all have 60%. So economists are expecting a recession in the UK, US, and Eurozone. But meanwhile, actual economic data continues strong. So this is the Fed GDP Now estimate using contemporaneous economic data, and it's estimating that the US economy is doing just fine, thank you very much. So once again, leading indicators are predicting a recession, and increasingly so, as they have been for some time, but actual economic data shows that the economies are doing just fine, and actually the service sector is strengthening, and price pressures within the service sector are also strengthening. So all that begs the question, why have leading indicators been so wrong? Why haven't we had a recession yet? So reminder, this is the Conference Board leading indicator, and every time it gets to these negative levels, we have a recession, except this time. The cyclical economy is turning down. We've talked about this previously. The sectors that lead the economy into recession are construction and manufacturing, and they have been turning down for a while, but they're not yet negative, but they look like they are about to turn negative. And they normally turn negative in advance of a recession. Now, the coincident indicator, though, is not turning down. The coincident indicator looks just fine. And the coincident indicator is made up of non-farm payrolls, real personal income, less transfer payments, real personal consumption, and industrial production. And we know that consumption has been supported by savings built up during the pandemic, although those are rapidly being spent. And consumption appears to be supported by the fact that the lowest paid workers have had the highest pay rises, and their pay has actually outpaced inflation. Already, the lag between the leading index and the start of the recession is long by historic standards. There's an average of 8.4 months between leading index indicating the recession has begun and it's starting. And we're already at 10 months, and there seems very little sign of recession as yet. The aggregate coincident index remains positive. Now, the Conference Board leading indicator has historically given a couple of false signals here in the mid-90s. What the difference between now and then is that when you looked at the broad mass of components of the leading index, then the majority of them were actually strengthening. Now they ain't. So it seems like the recession signal is much stronger now than the couple of times when it gave a false signal. And manufacturing hours worked gave this weird false signal back in the 1990s, which was one of the reasons that the Conference Board leading indicator gave a false recession signal. Well, now there's a broad drop in manufacturing hours worked. Now, what's odd is that that has not yet really translated into job losses. So the lead lag times are elevated. The leading indicator, the red line, is the cyclical economic index. and it's turning down, but very slowly. So part of the explanation for the resilience of the economy is that the bottom 10% of workers have done the best from recent wage rises, and they have highest propensity to spend. So they've been supporting consumer spending. But also, we've had much fewer job losses than we expected. Normally, you would expect falls in the ISM manufacturing PMI to cause job losses, but not really this time as yet. And again, we've had a fall in job openings, and you would expect that to cause a rise in unemployed workers, but that hasn't happened either. So companies are retaining workers, and that means that the recessionary dynamic by which unemployed people cut their spending, which leads to reduced revenues for companies, which leads to further job losses, hasn't really started yet. So in summary, the lag between leading indicators and the actual economy is unprecedented. And the leading indicators continue to worsen and continue to forecast a recession, but we have as yet seen no sign of that in the hard data. Returning to the question of, does producer price inflation lead CPI? Now, so we talked about this a few weeks ago, and I said then that PPI did not lead CPI because they're both based on the same data set, which is against the sort of market wisdom. Reminder, this is CPI and PPI, and we concluded then that PPI was just a more volatile version of CPI. They moved contemporaneously. PPI did not lead CPI. But Simon W. from our Discord channel sent me this. It's from Andreas Steno Larsen, and he is saying that PPI does lead CPI by 1 month. So higher prices for producers follows through to higher prices for consumers by 1 month. Now, make of that what you will. The PPI uses the same data as CPI, just with different weightings. So I remain of the opinion, actually, that the two move contemporaneously, but there are other opinions out there. Draw your own conclusions. And on to El Nino. Now, El Nino is something I've heard discussed many times, but I've never really understood what it is. So normally what happens in the Pacific is you have winds that blow from the east towards the west, and they move warm surface water from the coast of South America towards Micronesia, the coast of Australia. And that's important because that allows cold water from the deep to come up towards the coast of South America. So you get a circular flow. Now, what happens in El Nino is the trade winds weaken and they don't blow the surface water west. And so you then get warmer surface waters towards the coast of South America, which stop the upwelling of cold water from the depths. And that in turn diverts the Gulf Stream, and that in turn diverts winds and the jet stream. Now, La Nina, which is what we've had for the last 3 years, happens when we have very strong trade winds, and they strongly push surface water towards the west, towards Micronesia and China and Australia. And that allows large upswellings of cold water in the Eastern Pacific. And this is a self-reinforcing cycle. So you increase the temperature differential on the surface seawater, which increases the trade winds. Now, how do they affect global temperatures? Well, pause and take a look at these maps. This is El Nino, and you'll see during El Nino, you get a lot of rainfall falling in the Pacific, and that means drier conditions around the Pacific. So the northwest coast of Canada and the US in particular tends to be drier, as does southern Australia and India. La Nina, for the other hand, you get more rain across Asia and across the coasts, the northwest coast of North America. So La Nina means more rainfall. El Nino tends to mean drier conditions. And it looks like after 3 years of La Nina, we are going to have an El Nino year. And that means drier conditions, although it tends to mean wetter conditions over the southern United States. Both El Nino and La Nina are associated with extreme weather conditions, and we can but wait and see what happens. El Nino can cause severe drought. Onto other charts. So this is the maturity profile of US government debt, and you'll see they borrow short, not long. And that means they failed to lock in very low rates during the pandemic and are now having to refinance themselves short term at much higher rates in the bond market. And as a result, US government interest payments are going parabolic. The US government also needs interest rates to come down to make its debts affordable. But thanks to inflation, despite the rise in US debts during the pandemic, its debt burden, debt to GDP, has actually fallen over the last couple of years. And if we look at the Eurozone and the UK, you'll see the UK has also had a big rise in its interest bill because a large portion of its debts are index linked, and that should fall as inflation falls. So the UK government also has a big incentive to get inflation under control. You notice that the Italian government deficit is once more out of control. Okay, and on to good news. And this is a Nepalese tiger, and its population is up 190% since conservation measures began in 2009, which is actually not that long ago. And they've cracked down on poaching. So all that is great for biodiversity. We can save the wildlife if we actually try. Okay, and on to equity markets. So data as of 8:30 this morning, the all share had a poor week, down 0.6%. Stocks Europe the same, S&P 500 1.8%, NASDAQ 1.4%. Actually, these numbers aren't too bad considering what's happened this week with the failure of First Republic Bank and a widening crisis in US regional banks. Hang Seng, on the other hand, was up 0.5%, having fallen sharply over the previous few weeks. Topics up 0.9%. Bitcoin followed equities down 1.2% on the week, but up 76% year to date. The dollar weakened and sterling rose by 1.2%. Euro rose by 0.3%. VIX increased, but is still low. It's at 19.5. And that means it's still in sell territory. Some charts pertaining to equities. And just we talked earlier about how the Fed usually cuts rates when manufacturing PMIs are in strongly negative territory. Well, it also generally cuts rates when earnings per share are falling sharply. And we know that earnings per share are now down year on year, and yet the Fed is still tightening. We expect a lagged effect from rising interest rates to put further pressure on corporate earnings. And this has been a very long bear market so far. It is rare for a bear market to last much longer than 300 days. And this one shows no sign of either reaching a new top or reaching a bottom. And equities remain expensive on every measure you can think of. So this is earnings yield versus treasury yield. You are not getting any yield premium for taking the extra risk of buying equities in the US. And with 44% of S&P 500 companies now having reported Q1 earnings, generally accepted accounting principle earnings are down 1% year on year. And the market's actually expecting earnings to rise later in the year. And if the economy goes into recession, that seems frankly delusional. And that would mean a big correction in share prices as the market discounts much reduced earnings expectations. This is the cyclically adjusted PE ratio, and you'll see it remains very high, though down from its peak. US equities are not cheap. We talked many months ago about how the best predictor of future equity returns is the investor equity allocations. And right now it is implying that the S&P over the next 10 years will return about 2% per annum. So not great. Again, equities look overvalued. And on to commodities. Well, before we go through the data, we look at energy prices. They are drifting back down fast, actually. So we know a lot of inflation was caused by the surge in energy prices in the UK and Europe. And as energy prices fall back, you would hope that inflation also falls back. So going through some data, well, oil prices had a very bad week, down 6.6% for Brent and 7.6% for WTI. Now, so the energy markets are feeling increasingly pessimistic about demand. Natural gas futures continue to fall in Europe, down 8.5% in Europe and 11.5% in the UK, 11.9% in the US. So gas futures continuing to drift back towards their pre-pandemic lows. Coal down 6.3%, bucking the trend. Uranium up 3.1% on the week, up 10% on the year. Some numbers specific to the oil market. Well, we continue to have inventory draws overall in the US. So that should imply that the US oil market is undersupplied, which is bullish for oil. But again, we saw a sharp sell-off in oil prices this week. US crude production rose by 100,000 barrels up to 12.3 million barrels, its recent highs, and the Baker Hughes rig count was flat. So this is the oil price, extraordinarily volatile recently, but back to its recent lows. So the oil market thinks that demand is slowing, i.e. economic activity is slowing. So the oil market believes in a coming recession. As we talked about earlier, US oil inventories are low and falling, and HFI research calculates that actual US oil production has been falling recently. and they're forecasting a tight market for the rest of the year. But obviously, the oil market this week disagrees with them, and a lot of their forecast depends on the outlook for demand. If there's a recession, then they could be very wrong. All the major forecasters are forecasting strengthening demand later in the year. Now, this is an important chart. What it shows is the break-even cost of drilling a shale oil well in the US in the various different basins. And we know that this week, the price of WTI fell to $69. And that implies that some of the less productive wells in all of the basins will not be profitable and will not therefore be drilled, although all the basins on average remain profitable. But it did not take much further falls to disincentivize drilling in large areas of all the basins. Refining margins are falling, which implies reduced demand from refiners for crude and weaker prices going forward. These are European gas futures drifting, continuing to drift, which is great news. The same for the UK, US falling once again towards lows, coal following natural gas down, uranium bucking the trend, and that looks like a bull market. We go on to industrial commodities. General weakness, I would say. Aluminium down 1.2%, copper down 0.3%, iron ore having bounced strongly on Chinese reopening is drifting up again, down 4.2% on the week, down 12% on the year. Lithium had a bounce, up 7% on the week, but still down 2/3 year to date. Neodymium drifting off, down 40% on the year. Tin bounced. Ferrovanadium followed iron ore down and is down 11% on the year. Some charts. This is aluminium moving towards its recent lows. Cobalt at its lows. Copper falling. And we've talked many times about the outlook for copper and the need for lots of copper for the green economy. Well, if you look at how long it takes to develop a new copper project, the numbers are frightening. To develop a new underground mine is going to take you around 10.5 years. To develop an open pit mine, it's going to take you 12 years. So all that copper we need for the green transition, we should have been investing in new capacity over the last decade, and we haven't. There's chromium, iron ore drifting off strongly, lithium. It remains to be seen whether the bear market is intact or that represents a bounce. Neodymium still drifting, nickel, the only commodity which seems to be in a structural bull market still. Tin having a bounce, ferrovanadium following iron ore down, zinc drifting. Precious metals, well, the turmoil in the US banking sector has been good for currency metals. So gold was up 3.1%, up 12% on the year. Silver up 4%, up 9% on the year. The industrial precious metals all fell. So the bounce we had last week was transitory. This is gold rising, and central banks have been adding to their gold positions since the great financial crisis and show no sign of cutting back. So the record gold holdings in official reserves was in the 60s. Could reserves get back there? You suspect they could. This is silver, platinum, rhodium drifting off again, palladium. And on to rates. Well, turmoil in the US banking system was generally good for bonds. So despite the rise in US interest rates, the UK yield curve generally shifted down. So 1-year rates was down 8 basis points, 5-year down 20 basis points. And yields in the Eurozone were also down. The market is currently expecting the Fed to start cutting rates in August, in 3 months' time. Now, normally the Fed pauses for around 5 months, but then cuts hard. And the bond market is expecting imminent rate cuts. But again, all these forecasts of falling rates imply a weakening economy. We're seeing no evidence of that as yet. So moving on to the UK, UK gilt yields are higher than US Treasury yields and Eurozone yields, government bond yields. And part of that may be because the UK government is selling a lot of gilts over the next couple of years. And so its spread versus Germany is rising. However, I'd also say that UK inflation is much higher than elsewhere, and it reflects the fact that investors are concerned that whether UK has got inflation under control. So this UK 2-year ticked down, 10-year. Now, the 30-year, actually, that is data from this morning after the markets opened, and it ticked up again this morning. And the same is true for the US. Germany, bond yields down on the week, but up this morning. Italy, Greece. No change to our view overall, although my call on bonds is looking increasingly bad, as I had expected that all the leading indicators would mean a recession and a fall in inflation, which is good for bonds. But as we've talked about this week and in many weeks previously, the actual economy is proving very resilient, although leading indicators are predicting it shouldn't be. In conclusion, the banking crisis in the US is back and likely to continue to worsen. We're expecting further bank failures. You saw just yesterday the 50% fall in the share price of PacWest. As confidence drains out of the regional banks, they will find it difficult to fund themselves. They'll find it difficult to retain deposits. All of that implies they'll have to be more conservative and cut their loan books. That will mean a credit crunch and a slowing US economy. But we've been forecasting a slowing US economy for quite a while now, and we have seen very little evidence for that. Overall, the economic data appears resilient and inflationary pressures persistent, particularly in the service sector. And on to my week. Well, I had a decent enough week, up 0.8%. And that was good versus the all share, which drifted off. And I am still having a very bad year, down 3.5%, and Unforming Richard and the all share. I follow the cycle, and I have been predicting that rising interest rates would cause a slowdown in the economy and a fall in inflation. And I've been investing in long bonds as a result, and so far I have been wrong. But the leading indicators continue to forecast a slowdown in the economy, and a credit crunch can only help that. So I am sticking to my guns, although it has been painful and frankly slightly mystifying. Now, so there are no buys and no sells this week. During last week, we had a very good group chat on the Discord, and we were talking about various oil companies. And last week I was going through some stocks, some oil company stocks that I sold back in May last year, and I thought I would go through some more and see how they're done. So this is Arrow Exploration. which has assets in Colombia, and it's been doing well, actually. Shares were up 33% since I sold them, despite a weakening oil price. So that is a company I would definitely be looking at when I buy into oil companies at the bottom of the next cycle, of the depth of the recession. BP has been surprisingly strong over the past year. Reminder, BP has been selling assets and shifting into renewables, in which it has little expertise, seemingly, and the economics are nowhere near as good as in oil, but still its share price has risen strongly since I sold them back last year, and the share price hit a peak of £5.60. I sold at £4.30. Currently, they're trading 14% above where I sold them. Capricorn Energy, with assets mainly in Egypt now, I sold at £2.10. Share price has been much higher. It's currently at around £2.25, up around 6% from where I sold them. None of these prices were adjusted for dividends, by the way. Enquest, however, in line with a lot of UK-focused oil companies, has been terrible. The windfall tax has really affected the profitability and future outlook for North Sea oil developers. Shares down 50%. That's painful. Harbour Energy, shares down 42%. The same, painful. i3 Energy, again, shares drifting off, down 36%. PetroTal, which has assets in Peru, and which we did a share talk on, shares up 8%. Heavy oil assets, that looks pretty good. I will be definitely looking at that again next cycle. Serica Energy, gas in the North Sea, not great. Shell, up a bit since I sold, up 3.4%. Tullow Oil, disastrous, down 55%. Zephyr Energy, not great, down 37%. So I think you could say that oil company shares are in general down in the last year since I sold them, and that the majors have held up well, but some of the mid caps have got absolutely slaughtered. And the windfall tax in the UK has certainly had a very bad effect on the share prices of North Sea oil producers. We will be discussing oil companies further as we approach the bottom of the cycle. Now, unfortunately, Richard has had to go early this week. So that's it. Thank you all for watching. Please, can you press like and subscribe to the channel? And it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.